In this video, part 3, we're going to calculate the cost of debt, the cost of preferred stock, and the cost of equity capital. So let's look at this overall. The firm's cost of debt is the interest rate it would have to pay to refinance its existing debt through a new bond issue. So it's a forward-looking cost of debt. It doesn't matter what your debt cost last year. It just depends on how much you would have to pay to refinance your existing debt or issue a new bond issue. Existing debt trades in the marketplace, so its price fluctuates depending on what happens to interest rates within the economy. The return paid to the debt holders is not the same as the cost of the firm. The difference arises because interest paid on debt is a tax-deductible expense for the firm, but the interest received by the bondholders is higher. So Uncle Sam is paying part of the interest to those bondholders. This is an important point. So these are the 3 important points of the cost of debt. Let's look at the cost of preferred stock and look at some reminders. Remember that preferred stock pays a constant dividend each period, and it's paid forever. So it is a perpetuity. So we take the perpetuity formula, rearrange it, and solve for the cost of preferred stock. We did this in an earlier chapter. The cost of preferred stock equals the constant dividend divided by the price today. So these preferred stockholders are promised a fixed dividend, which must be paid in preference T, in other words, before any dividends can be paid to the common stockholders. Another way of looking at this, the cost of preferred stock capital is the preferred dividend over the preferred stock price, as we illustrated in the previous slide. Let's do an example. Alcoa preferred stock has a price of $54.50 and an annual dividend of $3.75. Its cost of preferred stock, therefore, is $3.75 divided by $54.50, which is its price, or 6.88%. This is the after-tax cost of preferred, and it's the before tax equals the after-tax cost. Come back to the cost of debt. It is the required return on the company's debt, and we're going to focus on long-term debt or bonds, long-term debt going to a bank or issuing bonds by the firm, because the long-term nature of this finances long-term assets. The required return is estimated by computing the yield to maturity on the existing debt. Now we know that yield to maturity changes as time goes on. So we did this in Chapter 7. The way to find the cost of debt is simply to compute its yield to maturity. You can also use estimates of current rates based on the bond rating we expect when we issue new debt. So we may look at other debt that has the same level of risk as our company and use that as an estimate of the current rate on the bond that we're going to be issuing. But in any case, the cost of debt is not the coupon rate. The coupon rate was the cost of debt for the company when the bond was issued. So we're interested in the rate we would have to pay on newly issued debt, which could be very different from past debts. What about taxes and the weighted average cost of capital? I mentioned before that we want the after-tax cost of capital. We need to consider the effect of taxes on the various costs of capital, because interest expense reduces our taxes. This reduction in taxes reduces our cost of debt, and the firm only gets a tax deduction for interest expense. It does not get a tax deduction for dividends or payments to equity. So this reduction in taxes reduces our cost of debt. So the after-tax cost of debt is the one that is important here. And it is the cost of debt, R sub D, times 1 minus the corporate tax rate. Again, dividends are not tax deductible, so there is no tax impact on the cost of equity. All you have to worry about is the after-tax cost of debt. So rewriting the equation again and using a little bit different notation, you'll have to get used to different notation standing for the same formula. The weighted average cost of capital equals the weight of equity times the cost of equity. There is no 1 minus t there because equity, the cost of equity is not tax deductible. Dividends are not tax deductible. Plus the weight of debt times the cost of debt, 1 minus the tax rate. That is after tax because interest payments on debt are tax deductible. Now, if we have other financing that's a significant part of our capital structure, we would just add the additional terms to the equation and consider any tax consequences, such as plus the weight of preferred stock times the cost of preferred. Let's do a cost of debt problem. By using the yield to maturity on GAAP incorporated debt, we found that its pre-tax cost of debt is 7.13%. We were given the future value, which is 1,000, the present value of the bond, the number of time periods till maturity, and the payment, coupon payments, and you compute I per year, or the yield to maturity, and it is 7.13%. GAP's tax rate is 40%. So what is the effective cost of debt? Well, the effective cost of debt is the cost of debt 1 minus the corporate tax rate. So that's what we'll do. So let's execute that problem. The effective cost of debt is 0.0713 times 1 minus the corporate tax rate of 40%, and it's 0.0428. Move the decimal place over 2 places to put it in percent form, and it's 4.28%. Now let's look at the cost of equity, or as your book calls it, the cost of common stock capital. You know, the cost of equity is the return required by the equity investors, usually the stockholders, the shareholders, given the risk of the cash flows from the firm. And the two big risks in the firm are business risk and financial risk. Business risk is the risk that people won't buy our stuff, the firm's stuff. The business risk is that demand is lower, and therefore people quit buying as much of the firm's products, goods or services. And it's also based on financial risk. And financial risk means how much debt the firm has. So business and financial risk. Business risk is the risk of lower demand, and financial risk is the risk of debt. Because debt is good, it's tax deductible, but having more debt in the capital structure does make the firm riskier. There's two methods for determining the cost of equity, and you have done both of these methods before. One is the dividend growth model, and the other is the capital asset pricing model, or the security market line. So here is the capital asset pricing model. The cost of equity equals the risk-free rate plus the beta, the equity beta, times the market risk premium, which is the expected return in the market minus the risk-free rate. That is one way of estimating the cost of common stock capital. Another way is to use the dividend growth model introduced in Chapter 9, and this is the one where we assume that dividend growth is constant. So what we will do is, instead of looking backward at historical growth, we use these estimates produced by stock analysts, which are more forward-looking. So the cost of equity is rearranging the dividend growth model. The cost of equity equals the dividend in period 1, in 1 year or 1 period, divided by the current price of the stock today, plus the dividend growth rate, or it's the D1 divided by the price of the stock today plus the growth rate. We put everything together. The weighted average cost of capital then equals the weight of equity times the cost of equity, which is R sub E times W sub E, plus the weight of preferred times the cost of preferred. The weight of preferred is WP times the cost of preferred is R sub PFD. Plus the weight of debt, 1 minus the tax rate because interest paid on debt is tax deductible, times the weight of debt. For a company that does not have preferred stock, the weighted average cost of capital condenses to the weight of equity times the cost of equity plus the weight of debt after tax times the cost of debt. So we have looked at all of these factors, the weights and the costs of preferred stock, debt, and new common equity. So let's do the problem. The expected return on Macy's equity is 10.8%, and the firm has a yield to maturity on its debt of 8%. Debt accounts for 16% and equity for 84% of Macy's total market value. Its tax rate is 40%. What is the firm's weighted average cost of capital? We have everything we need. We know the cost of debt and equity, and we know the weight of debt and equity. So, to solve this, we are going to put it into the weighted average cost of capital formula, realizing that all we need to know are the cost of equity and debt and their weights, or their proportions in the capital structure. So the weighted average cost of capital is 0.108 times 0.84, which is the percent of equity, times the cost of equity, plus 0.08, which is the cost of debt, 1 minus the tax rate of 40%, times 0.16, which is the weight of debt. You do the calculations and we find that the weighted average cost of capital is 9.84%. Even though we cannot observe the expected return of Macy's investments directly, we can use the expected return on its equity and debt and the weighted average cost of capital formula to estimate it, adjusting for the tax advantage, of course, for debt. What this is telling us is that Macy's needs to earn at least 9.84% return on its investment in current and new stores to satisfy both its debt and equity holders.